I have a very old, probably the most well-known trader that I know in all the years, Larry McMillan here. Larry, welcome to the show. Larry, how are you doing? How's it going?
Good,
Good.
Fausto. Thanks for having me.
You know what? You haven't changed one bit. You look exactly the same that I remember you 30 years ago.
Yeah, well, okay, nice of you to say that.
So what have you been up to, Larry? How's the thing been going? How's trading been going? You still been very active in the market? I mean, what do you even see what's going on? I mean, if you have the Fed rate that's going on today and all this
Yeah,
stuff.
I mean, we're still we're still running a hedge fund, and then we have a lot of separately managed accounts that we trade, and then of course we have the newsletters. So we're staying up to date on it every day. I have a lot of indicators that I use myself, none of which is what the Fed is doing. But
Yeah. What are the indicators telling you then? What exactly do you see on the on your?
they're mostly bullish, but I'm a big proponent of the S&P has to confirm what your indicators are saying, or you're wrong because the S&P itself is always right. So we're right up here against the new highs. But we need to break on through. If we don't, then we've fallen back from here 3 times already. And so I'm looking for a breakout to above 56.70 to hold and advance from there. But I'm not going to say that's going to happen necessarily. So this is actually a good spot to buy straddles, really.
Is it
Because,
really?
yeah.
It's crazy. I mean, I've been, me, I'm being a day trader, and every day I'm looking at some of these stocks, and we're trading so many of them.
Mm,
When's it keep going? I mean, this is a hell of a bull market. I mean, we haven't had we had that small little retrace about a month ago, but it came
mhm.
right back. You know what I
Yeah,
mean?
exactly. That was so quick that it was like it didn't even show up in some of the like 21-day moving averages. It was barely a blink.
Really,
But
not even.
yeah, and you're right. You look at the new highs, new lows. New highs are exploding in the last 3 days. Even it's
Oh my God, it's and what I'm finding, like I was just at the Nasdaq Center yesterday. There was a big. I was at a conference at the in New York City, and people asking me like, is it too late to jump in? Is it too late to buy whatever it is? And I'm like, listen, there's always good deals. I mean, stop worrying about the fabulous seven all the time. But like, where are you moving your fund into? Is it a certain industry that people are looking at? Is it something? Is it specific stocks that you should be focused on? I mean, where are you looking?
Yeah, so we're technical. We trade off the technical indicators. We're mostly just trading broad market S&P type things. I mean, we do have one basic strategy that we use, which is put ratios on the S&P or the E-minis. But that's kind of a constant. We adjust that just slightly for volatility and things like that. But that's kind of a strategy for any market.
Yeah.
We don't really alter that one. But as far as the speculative stuff, which is what people are often most interested in, um, we just have a certain number of indicators, like put call ratios, for example. They don't necessarily follow an industry; they just follow individual stocks. So we just had a put call ratio buy sale in X-ray, which
Okay.
is it's breaking out a little bit. We'll see how it works out.
So how did you get into this whole business too? I mean, like, people always ask me, like why would you get like, how did you step into it? What made you get into it? I mean, where did you come from? My listeners always like to know a little bit more about us gurus, like why we out there and always preaching and be showing up at these events and stuff like that. But
Right.
how'd you get into it?
So I started out as a programmer at Bell Labs back in 1972, out of the Army and out of grad school. And, it was a great job, very interesting, a lot of smart people. But I really wanted to get to Wall Street. So in 76, I had an opportunity to move into an option department. Options were really very new at that point. And I went there, and within a couple of years, I was trading their proprietary account. So I did that for about 10 years. And that company was Thompson McKinney. It went out of business after the crash of 87. And so I went to Prudential for a couple of years. And the big firm wasn't for me. So I started my own business. And I thought I would just be trading, but it turns out that when you're used to trading 600 million in capital, and I didn't have that much money, so uh, I couldn't really trade the same way. And so
Okay.
I started the newsletter business at the time to just bring in some extra income. I knew some other traders who had done similar things, Linda Rashke, for example. And so that that was working great. And then we started to get a number of decent subscribers to that. And then people said, "Why aren't you managing money?" And I really hadn't been that interested in it, managing other people's money.
Uh-huh.
But we had some really good calls around the financial crisis time, 2008. And so we sort of got dragged into managing money. So since then, we've been in the money management business as well, both as a CTA and a RAA, which, that, how the regulatory headaches go, but
Oh,
still
they're really strict. Yeah.
worth it, so that, I mean, that's really how you moved into the whole thing. And would say that, I've learned a lot on of particular strategies. I've developed them on my own since then, a lot of research and things like that. We used to publish a lot of technical articles, almost like a technical analysis of
Okay.
Money's magazine, but we haven't been doing that in recent years. I've been keeping this stuff mostly just for our subscribers.
Okay. Do you still have the newsletter you still pump out or no?
Yeah, so we have actually 5, and we're probably going to be launching another one. But the original one, the Option Strategist, is in its 33rd year of publication right now. So
Are you still doing a lot of options?
yeah, we do. I mean, all of our recommendations basically are options, almost
And
100%.
and 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 what style of options you usually
Yeah,
telling people
so
like what's your expertise
so
on it?
I'm pretty much if I'm I mean, if I'm setting up a position because a straddle the options are cheap and I'm buying a straddle, that's one thing. But speculatively, I try to pretty much trade them straight out right. I don't like the bull spread thing that everybody seems to be doing on
Yeah, a
TV
lot
all
of people do
the
that.
time. You just cut off your upside. I mean,
Mhm.
if you think you're risking too much and buy a few, buy fewer calls than you would have normally, let's say,
Right.
but don't cut off your upside. I mean, example, earlier this year, I read an article actually in Barron's about how chocolate prices were going to be going up. So I took a look at the cocoa chart and it looked really bullish. So I bought some options on cocoa. Well, the thing went crazy.
No,
It
did it? Yeah.
went it went up 80 points, which is $80,000 in the futures. I didn't make that much money in the options, but about half of that. And so, um, if I'd have spread it, though, I wouldn't have made hardly anything. I mean, I would have made something, maybe 10. So it's a to me, it's spreading the bull spread. If you're going to speculate, let's speculate. The old
Right.
saying, if you're going to play poker, let's play poker.
When you look at it that way, I never really looked at it that way, but you're right. And you know what's so funny? I tell people that all the time. It doesn't like here you are talking about cocoa. And you're like, I would never even think twice of even thinking of trading that more, that trading cocoa. But
Mhm.
you see a news article on it, you see something that's happening, and sure enough, I mean, I look at it as advertisement, and by having that advertisement, that stock little, that cocoa took off. Uh,
Right. I mean, in some ways, the futures are almost purer from a technical analysis viewpoint than stocks are. So there's a lot of noise in stocks. There's less noise in futures. I mean, obviously, there's some fundamental stuff going on there that I know nothing about. Like, where's cocoa even from? I don't really know.
Hershey, Pennsylvania, maybe.
Yeah, yeah,
So what? So regarding about like I train a lot of options, and we have some options people in here. I know you've been doing. You're an expert at. Why is like between why people fail in options, and futures so bad? Like I did in it's funny when I did it. I was just like I said, just told you earlier before we started. I was at the Money Show. I was at the Toronto. I was in Toronto this weekend, and I told everyone. And who has ChatGTP? And I says, well, everyone raised their hand. I got it. I says, why don't you ask ChatGTP, what is the failure rate if getting into trading? And, and it was 90%. It told everybody. So everybody's like, well, why are you getting into this business when it's a 90% failure rate? And they said, now ask ChatGTP, the success rate if you actually got a little education of it. And all of a sudden it says, oh, now you're within the 30, 40%. So, and everybody's like, why? Well, I have, I'm talking about stocks, but in your point, being futures, we have a lot of people, futures and options. Why is such a big failure rate in their part?
Well, I mean, options, I think it's two things. One, people buying options too far out of the money. My indicators are trying to predict where the underlying is going. So I'm going to buy an option that's going to make money if I'm right about the underlying. I mean, I really hate being right about the underlying, losing money on my option trade. So that can only happen if you're buying deeply out of the money. But I think a lot of people do. And a lot of people fail to adhere to the only risking 3%, let's say, of your trading account on any one trade. They
Right.
pile into some trade and then get blown away, and they're done. So I mean, I think those are the two biggest mistakes that people make. But yeah, I guess it all kind of falls under discipline.
Yeah.
Yeah.
A lot of it comes with discipline. A lot of it comes with psychology part of it too. And I try to talk to more about people when it comes to trading. It's not about the winners; it's about the losers you have to learn from. That's basically, and you're going to lose in trading. I mean, it's part of the game. When you lose, I lose. We lose all the
Right.
time. You just
Yeah.
want to lose too much. You know what I mean? It's
Right.
like,
Except some of those guys who were doing what was the guy who claimed they winning for like 200 days in a row or something, but they were using they were kind of like front running the trades with
oh,
the high speed technology and all that.
I still don't buy that. I
Yeah,
still
I
don't buy
know.
that.
It's
I
still trading, right?
It's still great. I mean, you and I have been around long enough, and we saw people come and go, and it's just like that is, I see people on the internet all the time. I tell people, got to be careful what you listen to, because you know what people do? They go out there and they pretend they have two accounts, and they buy one and they sell the other, and if they lose, the winner makes it, and they show you the winner part of it. You
Right.
know what I mean? So how do you know he really won? I mean, I don't buy that. I mean, that doesn't make any sense to me. But on that aspect, what have you been working on now, Larry? As in, like you say, you got a new letter coming out. I mean, like, what exactly
Right.
is you've been working with option strategists?
Yeah, so our basic three letters are the option strategies, which comes out once a week. Then we have two daily letters, but we're going to be launching a macro letter, which is kind of covers a lot of other markets that volatility on, say, European markets and things like that. And we've got a couple of other ones. One is just put writing, conservative put writing, which it's a slow way to make some money, but it works.
Yeah,
So that's the one you always see, like, oh, 95% profits. It's what you do with 5% losers that makes a difference. So um, if you're selling put far enough out of the money, you're going to make money 95% of the time.
So
But
so so
I'm sorry.
regarding about that, I'm glad you brought that up, because people always ask. I mean, what do you find is like like one of the biggest challenges that people overcome regarding about that?
Right. So, well, again, it's sort of a discipline thing, but so I'll see people say, well, I'm writing puts 1.5 standard deviations out of the money. Well, if you actually look at it, 1.5 standard deviations occurs fairly often, especially in the stock market. So
Right,
that's too tight. You need to be farther out of the money than that, because you're going to get blown out on one of those. Just especially if you're doing stock options, index maybe, but stock options. I mean, stocks drop like rocks, all the time. And
right.
there was one this year, Riley Financial. I don't know if you paid much attention to that. I think the symbol is RALY. It had expensive puts for months, and then eventually they missed an earnings report and didn't file something or other, and the stock collapsed. So you could have made money for a while, and in fact we did. And then, but right before the thing really collapsed, the puts weren't really all that expensive anymore. So we'd stopped writing them by that point in time. So I think, again, it's a matter of discipline, and especially in those kind of situations, if it does start to collapse, just stop yourself out, take a loss. Don't wait around to find out the thing went to zero on you or something like that.
Yeah, they just write it down. So, do you recommend people? I mean, if you have some money, right, laying around,
Mhm.
you recommend people to sell options and try to just make premiums?
So, I mean, most of our newsletter, I mean, there one is selling puts, and that those are we do it in a very methodical, conservative way. But I've found, especially really since 2009, the market's been very strong. I mean,
Hmm.
yeah, it's been a little here and there, the pandemic and that, but basically pretty strong. People that did cover calls are against stock they already own were not happy.
Yeah.
So I would say that the option selling thing is not very popular with most people. They try
Why
it.
is that? Because they can't afford to buy, because they have to own the stock. I mean, why would?
Yeah, well, what they'll do is they'll sell it against a stock they didn't really want to sell, like let's say an inherited stock or the stock from a company they worked for a long time or something like that.
Okay.
And then so in effect they're selling a naked call because they really don't want to sell their stock. And once you get yourself in that situation, it's a grind. It's that's not fun. You wake up every day rooting against your own stock. So
It's like playing
that's
the don't pass line on craps.
yeah, yeah,
Everyone.
yeah, yeah. So don't do that. But 0 data exploration, we're going to be doing a 2-part seminar on that coming up here and webinar or whatever. I have been trading that to a certain extent. I think again I have a pretty mathematical basis for that. I mean, obviously, a day like today with the FOMC is coming out, you don't really know what's going to happen.
Right.
So, uh, so the options are very expensive, and they should be. So I don't really have a position today, but on a normal day, there are plenty of ways to make money in that. And I really don't think 0 day to expiration options are causing any market problems at all, despite the occasional article in Bloomberg or Barron's or something.
Okay.
Yeah.
What do you think of what do you think about doing leaps?
Yeah, so I mean, typically leaps are really overpriced. So
Yeah.
the market makers love to sell them to you.
They do, huh? Okay.
Yeah, and they'll hedge themselves until some later time when they can buy them back. Um, I mean, they have a purpose. I definitely think if you're trying to do long-term collars to protect your stock, leaps make sense then because of the way options are priced on a log normal distribution. But in general, again, if I'm speculating, I'm not looking that far out in time.
No, not that
Um,
far. Yeah, I mean, was it at least what, a year?
yeah, leaps are a year. Well, now I think in some cases you can even do a 2 or 3 year option. And
Oh, you my
yeah,
God.
so
Are there a lot out there or no of leaps? Like you said, they like to sell them. Do all stocks have leaps on them?
pretty much. I mean, some of the less liquid ones not, but all the big stocks do.
All the big stocks do.
Yeah.
Okay.
So again, I mean, when you bring up your option montage and whatever screen you're using, you're probably not even looking at those. They're probably way off your screen on the right hand side somewhere. Yeah.
So if I'm new, because we have a lot of people listening in, and like I said, a lot of them out there are listening to so many people that trade options. You know what I mean? I mean, and you're like one of the biggest, most popular gurus out there that have been teaching options that I know. Um, how does somebody get into it? Like, what's the most easiest way to kind of understand an option that you would recommend when you teach them? I mean, you taught tens, hundreds of thousands of people over the years. I
Right.
mean,
Probably not as many as you did.
uh,
But,
you've been around a
well,
long
I mean, just to understand the basics, I mean, obviously we have books, we have educational stuff. It's not a lot of other people. Um, but you need to have some education, as you pointed out. If you just go in blind, you're probably going to end up um, losing money. So, you need to get the education and then get the discipline. So I think that's why our newsletters help.
Okay.
In that regard, you can have you get to see what's going on. You don't even have to necessarily trade them. You can just see how we're trading them. and notice that we trade in the money, that we have stops, that we I'm very big on rolling up an in the money option. I usually say you buy a call and stock goes up 6, 7, 8 points, roll that call up. It reduces your upside profit potential a little, but it puts some money in your pocket. And if the thing turns around and goes back the other way, you're still ahead.
Okay. Do you recommend, have you been recommending, any of the metals like gold? Gold's been doing pretty well or anything like that? Have you been trading any
Yeah.
of those?
Well, I mean, I'm a fan of gold. I don't think we have any position in it right now. No, I don't think so. We're in the futures right now. We're in cattle, wheat, that
Cattle and
sort of
wheat.
thing.
What about
Uh,
crypto? You doing any on options on crypto at all?
yeah, well, we do have one trading system that we look at that does follow the crypto markets.
Okay.
So that's covered in our daily strategist newsletter. But you know, right now, I we don't have any position in any of our newsletters in crypto at the moment, but we could from time to time.
Okay. But the style that you teach more or less, you could apply it towards any type of, you
Yeah,
know
so that's why my feeling is like an option is an option, you
Right.
know. So if it's futures or stock or whatever, there's a little nuance, but not a lot. Cash base, okay, or not, or non-cash base, fine. Futures they trade with uh, basically no cost to carry because there's no cost on the futures. So um, the premiums are a little bit different on puts and calls, but still, it's still the same thing. You buy a call, the underlying goes up, you make money.
Okay. Well, could you do the audience a favor and show us a little bit about your newsletter or the style that you've been working on, or so we kind of educate a little bit?
Yeah, so I've got some like what current charts, and I can just relate how our indicators are looking
Yeah,
at those charts currently. So
yeah,
let
that'd
me
be
see if
awesome.
so do I have to hit share screen or something? I guess I do, right?
Yeah, that middle screen, share screen, and then just click on the entire screen, whichever one screen you want to share.
Right. So you see
Yeah,
that? Yeah.
yeah, there
Okay.
we are.
So as I said before, the S&P chart is the number one thing that we use as a gauge for everything, really. But we've been running into resistance right here at 56.70. I mean, technically, we made a new high yesterday by 50 cents or something like that. So we've moved right all the way up to a new high. But you can see we've fallen back from it here once, and then after trading in this range for a while, twice. And so, we really need to break on through here, or I think, the third time might be the charm for the bears. If we do fall back, obviously we had that support of 5,400 and then 53.70. So, but I mentioned one of our trading. So this is one of our trading systems right here. So we draw what are called modified Bollinger Bands around the S&P 500. So that's the 4 sigma band right there and the 3 sigma band. So if you come outside the 4 sigma, you go back inside the 3 sigma, that's a sell signal. So that one worked out pretty good. And we stop ourselves, or we take our profit if it reaches the opposite band. That one generated a buy signal on August 12th, which is still in effect. That's why it's a green letter on this chart. And we're shooting for this upper band being the target, 57.75. Now, as I said before, when options go deep in the money, we roll them up. And so we have rolled this position up a couple of times, but we're still long based on that signal right there. This concept is what we call McMillan volatility bands, can be applied to other charts. So we use TradingView to draw these charts for subscribers, but you can subscribe to this. And this is the same chart we just looked at. There's the buy signal that's currently in effect. There was the sell signal that before that. And this is updated, all day long. But here's one, Wells Fargo. We got a buy signal on that. It ran right up. This chart is not up to date, but it ran up to 59, and we sold it there. There's a couple of new ones we just moved into. Google gave a buy signal on this system, and so did Walgreens, the biggest dog in the world. Uh, so it gave a buy signal there too. So McMillan volatility bands is something we follow both in the option strategist newsletter and in our daily strategist newsletter. But perhaps more interesting, and a lot of people I think come to us regarding the put call ratio, because we do a lot of work with put call ratios, and basically here this is the S&P 500 up on top here, and down here's the put call ratio. This is the equity only put call ratio. That's all stock options that trade. So when there's a local maximum in the put call ratio, that's a buy signal. So this buy signal came in about there, and it's still in effect right now. Um, this is using just option volume, but if we use dollar volume, get what's called the weighted put call ratio. And again, this gave a buy signal back here in August. It started to waver a little bit here, though. And we have some computer analysis programs that treat this sort of like a chess tree, kind of look out a little bit in time, and also know what's coming off the 21-day moving average. These are 21-day moving averages. So it's warning us that this is on the verge of a sell signal right here. So that's one indicator that if the market were to turn back from here, this would also confirm that, I'm sure. You can apply this to individual stocks. So I mentioned X-ray. We got a buy signal there, and the underlying stock just broke through 26 yesterday. This is one we're waiting on. So we got a local minimum on the put call ratio chart. That's a sell signal. But we're waiting for it to break 74 before we move. So if it just goes up here, we're no harm, no foul. But if it falls back below 74, we'll be buying puts on that one. This is just another one from a little bit while. I mentioned these. Here's cotton. We're long cotton right now. You can see it's breaking out. Put call ratio buy signal right here. Unfortunately, some of these you can only trade futures options. So cotton, you'd have to trade the options on the ICE. But this is wheat. Now wheat has an ETF. So this trades on the SIBO. Options on that trade on the SIBO. And we're looking to, we actually did buy options on wheat. And you can see wheat starting to break out here to the upside. And then the third one is cattle. You can see there's been a couple of decent buy signals in recent last year in cattle. So we just got a new one. There used to be an ETF, cow, but it doesn't exist anymore. Another thing we look at is market breadth. We've had positive breadth in the market now for 7 days in a row. And we look not only at New York Stock Exchange breadth, but also what I call stocks only breadth. That's all optionable stocks, all stocks that have listed options trading on them. There's over 6,000 of those. And so, that's a good, robust data set. And so right now, this is in overbought territory, but we have an old saying, overbought does not mean sell. And the corollary is oversold does not mean buy. So we'd have to see this stop being overbought before we'd actually act on it. So right now the breadth oscillators are very strong and they're overbought, but market can continue to go up while it's overbought. That's not a hindrance to it. It's when it stops being overbought you have to worry about it. Another thing we look at is cumulative volume breadth, and that's the volume on advancing issues minus the volume on declining issues. This made a new all-time high 5 times since August 23rd. Usually that's indicative that SPX will also make a new all-time high. I guess on a technicality, SPX did make a new all-time high yesterday, but only by 50 cents. I'm looking for it to really, go on through. This indicator is useful as a negative divergence. Obviously, there is no negative divergence at this time if the indicator is making a new all-time high. That doesn't mean a bear market can't start. I mean, not every bear market starts with a negative divergence, but it's somewhat positive to that extent. I mentioned new highs, new lows. We follow this a lot. The last buy signal here came on August 15th. That's still in operation right now. That's when on the New York Stock Exchange over here we had more than 100 new highs 2 days in a row. Right now, that data there is from last month. Right now, we're seeing 300 or 400 new highs every day. So this indicator is very, very strong right now. Still very positive. VIX, VIX has two purposes, in my opinion. The VIX chart, anyways. One is spike peaks or buy signals for the stock market as people panic and buy puts on the S&P 500. That makes VIX shoot higher. So all of these Bs are buy signals. The blue ones are losing trades. The red ones are winning trade. We had this huge one there in early August, and now we're operating on one right now that came in early in September. It was spiked up there to 23 and then right back down again. There was a secondary spike, but we're operating on a buy signal here. But the other thing with VIX is you also want to pay attention to the trend of VIX. And if VIX is trending higher, that's usually bad for stocks. Well, at this point right here, the 20-day moving average of VIX, which is this little guy right here, sorry, 20, and this is the 200. The 20 crossed over the 200 and VIX was above. So that set off what we would expect to be an uptrend in VIX. And for a while, it was a crazy wild uptrend, but it's in other words, VIX has not fallen down below its 200-day moving average. So this is really the only negative indicator in our whole arsenal at this point in time. Now, you can't trade VIX, but you can trade the VIX futures. In a bullish scenario, if you priced out the futures, you'd see that they have an upward slope to their term structure. That's bullish. If you see a downward slope in the term structure, though, that's very bearish. That was really evident in March of 2020 in the pandemic, but also was evident last August for at least a few days when we had those very negative movements in the S&P. Here's the current term structure of the VIX futures. And you can see from here on out, it slopes upwards. So that's bullish. But what's going on here is I call it the election bump. These October VIX futures are based on the price of S&P futures that expired just after the election. And normally the election would not cause a market volatility, really. But this year, the traders are expecting that it will. So that's elevated the price of October, and then indirectly that elevates the price of November. So if there wasn't the election, that construct, that term structure would worry me a little bit. But because there's an event, the election, other events, this happens all the time in stocks when they're going to report earnings. The near term gets it more expensive than the longer terms. We're still looking for a trade to take advantage of this, which we haven't put one on yet. But that's what exists in the VIX futures. Now the CBOE publishes 6 volatility indices: a 1-day, a 9-day, VIX is a 30-day, etc. So coming into today, the 1-day is very high, but that's because of the FOMC meeting today, and the 9-day also elevated. The rest of them slope upwards, as you might expect. So I'm thinking once the FOMC gets out of the way, these will all be sloping upwards, which would be, bullish. Right now, I put the little somewhat bullish sign on there. So if you add those all up, most of the stuff is over here in the bullish column. It's all over here. We got the spike peak buy signal, the FDV buy signal that was talked about earlier. The chart of the S&P 500 is not completely bullish until it breaks out over 5670, but new highs, new lows, spread. All these things are bullish. Realized volatility has fallen back into a neutral status. The only sort of bearish thing we have is that trend of VIX. VIX is still above its 200-day. So overall, this is why I say I'm basically bullish, but I want to see the S&P 500 break out here and confirm that. It just sort of repeats that same thing. We're also coming into a pattern of seasonal trading, and between September and through the month of January, there's a lot of good seasonal patterns. So the first one up is starts this Friday, and the trade is you sell the market after option expiration in September. Well, now we have option expiration every day, but what that referred to was the third Friday back years ago when we only had expiring once a month. So this coming Friday would sell the market for 1 week. The last 34 years, that's been 26 wins, 8 losses, and all 34 average together, you still got about a 1% drop in the market. Or, so now with the market up here around 5,600, you're talking 56 S&P points, which you can do in a blink. But still, worth trading. I mean, that's 5 or 6 points on the SPY. You certainly make some money on a trade like that. So we'll be entering that coming up this week. For your subscribers, if you're interested, or listeners, if you go to this URL, optionstrategist.com/podcast, we're offering a free ebook, 14 useful rules for option traders. I know, Fausto, you asked about, what we try to teach beginners. Well, this is really, I kind of remind myself of these rules sometimes because they're all useful. They're all definitely help you in keeping your positions in line, making profits, taking profits, stopping yourself out, all that sort of thing. And also the PDFs of this webinar would be available there. And then just one last thing, we're going to have a 2-day seminar on zero data expiration trading. If you like Thursdays, it's these 2 days. If you prefer weekends, it's these 2 days. So we'll include an Excel spreadsheet that I personally use for trading these, and setting up using the VIX 1 day as a guide towards realized volatility, because I think any kind of volatility trading, any kind of option trading, really, you want to take a look at your realized volatility versus your implied volatility. So I'm going to bring it back to you, Fausto.
Yeah, no problem. You know what? And that's I'm glad you shared that with everybody. And like I said, and if you're watching this as a recording or wherever, Larry does events almost every single month. So just subscribe to the channel and to his newsletter and get it, because listen, I read his newsletter. I always read everyone's newsletter, and you always learn something. Great traders never stop learning. That's what Larry. I try to tell everybody that you learn something new every day. You learn something for someone. If you pick it up, if it could tweak up a little bit your trading, that's all that really matters.
Yep. So I wanted to insert one other thing in here. There's a new book out by the guy Nate Silver, who had the 538 website. I don't know if you know that one, 538.com. It's all about probabilities. Anyway, the book is called On the Edge.
On the Edge.
The edge, referring to edge playing poker, edge investing, and that sort of thing. So it's pretty funny. But the reason I liked it, because I consider myself a decent poker player. So I played in the World Series event. A couple of them. I moneyed in one of them that had 5,000 entries. So I felt pretty good about my poker game after that. So one of the theoretical questions was like, what would I be doing if I wasn't doing this? I think I might be doing that.
Playing poker. And you know what? You don't strike me as a poker player, but I can see you got the poker player face. So
yeah, there's been some articles recently about how some of the big trading firms, option trading firms, are requiring their young trader or new recruits or whatever to play poker or learn poker.
Really?
Yeah, because it's you learn how to take risk in a sensible manner without getting blown out. But like Susquehanna was one of them. Apparently Jeff Yaz is he's the number one partner.
That's great. You know what? I never even thought about that. Actually makes perfect sense. It's like, obviously you're trading, well, you're trading with other people, but even like trading the house, if it's blackjack or whatever, you got to know how to take risk and not blow up your account. Texas Hold'em, Tom's saying,
Right.
Well, Larry, listen, thanks for coming here, and I'm glad appreciate everyone. Also appreciates you sharing your knowledge, and and everyone take Larry up on his newsletter and attend his event. But got to have you back, Larry. It's been a pleasure. It's nice always seeing you again. Still at it.
Good to
Still
see
in
you.
here. Yeah, same here. So
All
everyone,
right.
thanks. So thanks everybody for listening, and everybody, we'll have a recording for everybody to watch us a little bit later. We'll have a couple of highlights and everything else. So please feel free to subscribe to the channel. And Larry, thanks for coming. Oh, and
Okay.
thanks very much.
Thanks very much.